Stuart, great to have you on today. I know that you've had a relatively easy past few weeks, so great time to have you come in and guest host with me. Talk to me about how you would categorize where we are at in this moment in markets. Can we believe any moment of reprieve and green that we might see on the screen?
Honestly, it doesn't seem like that. I think the message from the last call a week to 10 days has been the bad news is not fully priced. And I think that's at the stock level and it's at the market level as well, where you get headlines that, might have seemed relatively, run of the mill. Even Chair Powell yesterday gave you kind of a textbook answer. Tariffs are bad for growth. They push inflation higher. Yeah. And markets still sold off on that. So I think the message you're getting here is we're not out of the woods. Worst case things are not fully priced in. All that said, I do think the tariff delay and a little bit of flexibility on the electronic side does trim a little bit of your worst case tail risk off, but obviously is not to solve the problem at all.
Talk to me about that, because what was interesting to me about Powell was that this was his first time speaking since we had that 90-day negotiation news, and I didn't hear him sounding any more optimistic. If negotiations don't matter for Powell, should they matter for markets?
I think they definitely matter for markets. The Fed's been very clear. They're not going to incorporate anything into their forecast that isn't, fully implemented and happening now. They don't want to be dragged around by headlines or rumors or anything like that in either direction. Markets are obviously different. The markets are pricing a probability distribution on the outcome, and each headline can kind of, impact that. Our view is that the next 2 to 4 weeks extremely important. We need to see some good news on the tariff front, especially with our key kind of trade partners. If you get that, I think the market will say, okay, this is a playbook for how this can evolve over the next 3 months. If you don't get that, I think the market's going to have to really start to increase the recession odds on the view that these tariffs are going to be higher and longer implemented than they might have hoped.
And where do those scenarios potentially leave us? If we do get these negotiations, where do you see the S&P heading? If the negotiations don't pan out, how much more pain could there be?
Look, I think, we're in a very wide trading range here, call it 4,900 to 5,400. I think if you've got good news on the tariff side, you can get out above the upside of that range. It's hard to see us getting above where we were, let's say, on April 1st, which is kind of that 56 to 5,800 range. So yeah, I think you can get up to those levels if things go very well. On the downside, the support level is 4,900. And I think to get below that, you're going to have to see people start to increase the odds of recession, really cut the earnings and GDP forecast going forward. What the support level is below that, we're really not sure. You're going to have to explore that, but I'm sure the market will start targeting, 4,700, 4,500 on the S&P if we were to get to that level. And that's a big if, of course.
And we came into the year just with so much optimism. I was talking to so many investors the day after the election who were incredibly optimistic. They have since sent me a lot of worrisome text messages about how their portfolios are doing to start off the year. To what extent do you think that investors need to be hiding out in safe areas of the market while this starts to play out? And what does safety look like right now?
It's a good question. We do think you want to be quite cautious in terms of your equity allocation. I think the positive news we've seen to start April has been growth stocks have performed very well. They're up 10 out of 12 days. And that's going to be obviously a lot of tech is involved in that. But if we rewind to February, these were your most heavily held and highest valuation stocks. The valuation, I think, has come down enough over the last, call it 2 months, that people are again looking at the fundamental side of growth and saying this is maybe safety in the equity markets. If earnings estimates get revised lower, there's going to be a scarcity premium on the stocks that can provide that. And most of these large cap tech and growth stocks have a nice clean balance sheet. They pay dividends. They buy back stock. So I think what you've seen is the painful derating in valuation has actually now opened up an opportunity to be in those large cap growth stocks as kind of a hiding place right now.
And one of the things I love talking to you about, Stuart, is what we're seeing in terms of retail investor activity, which you monitor so closely. How have you seen retail investors behaving specifically with regards to tech allocation?
Yeah, I think you kind of need to break retail into multiple parts these days. But the what we would call passive retail, which is kind of your buy and hold in your 401k community, they've definitely pulled back. There's been net outflows from ETF and mutual funds 4 out of the last 5 weeks. The retail trading community, if you look at something like levered ETFs, which retail traders like to use, the shares outstanding on those are basically at an all-time high. So I think what you've seen is a pullback in that more conservative buy and hold investor, but your retail sort of in and out folks, still seem to be involved. I do think our view would be that retail does tend to gravitate to large cap tech and growth stocks because, frankly, those are the largest weighting in the indices. And in your 401k, you're usually choosing between S&P 500 and NASDAQ 100 or something like that. So I do think think the pullback from that community has added a little bit of weight on top of that kind of large cap growth cohort. But the folks that like to trade are still trading. So
this brings me to kind of a philosophical question I want to ask you about. A lot of the investors who I talked to in the retail space got started in 2020. They've enjoyed a lot of the AI euphoria over the past few years, and they're getting hit with a lot of reality now. To what extent can those more novice retail investors survive in this market without the institutional knowledge that hedge funds who move the market up $7 trillion in 10 minutes have?
Well, I tell you, some of the hedge fund community is complaining about what retail is doing to the market. So I think there's a little bit of a give and take there. Our view, look, the bottom line is there's a lot of ways to hedge. One of the biggest ways to hedge is just to own less. So I think if you're worried about the volatility in the market, you start with smaller positions and you kind of leg your way in as appropriate. So that's the easiest, most simple way to do it, I think, is just to be more conservative in the top type of stock you own and the amount of that stock that you do own.
All right, great advice, Stuart Kaiser. You're going to stick with us for the hour. Really appreciate your insights there.